Good morning. In recent months, I have seen economic discussions centered around one name, Trump. But this is not about politics, it is about economics. I am looking at the concrete policies that shape our markets, affect our investments, and influence the global economy. Today, I will break down Trump's economic strategies, examining both the advantages they promise and the real risks they pose. My aim is to offer a balanced, data-driven analysis. The core strategy rests on three main pillars. First, protecting domestic industries through tariffs. Second, slashing corporate taxes to encourage business investment. Third, removing government regulations to unleash what economists call animal spirits, the confidence that drives spending and investment. The Tax Cuts and Jobs Act of 2017 reduced the corporate tax rate from 35% to 21%. The promise was simple. Lower taxes would mean companies keep more profit, which they would reinvest in America. Real business fixed investment did increase, and on paper this looked like a win. I note that tariffs place taxes on imported goods, making foreign products more expensive and encouraging consumers to buy American. In theory, this can strengthen domestic manufacturing and create jobs at home. Countries like Japan and South Korea built large parts of their economies this way decades ago. I believe lower corporate taxes can spark confidence, encouraging companies to expand, hire workers, and invest in new technology. That animal spirit can snowball, with more investment creating more jobs and higher consumer spending. Tariffs can also reduce the trade deficit by making imports more expensive, which arithmetically contributes to higher GDP growth. Lower tax rates also reduce incentives for companies to move their headquarters abroad, keeping tax revenue at home. But there are significant risks to consider. When tariffs were announced, markets reacted violently, with global stock markets losing roughly $10 trillion in value in 3 days. High tariffs disrupt supply chains and increase costs, and some estimates put the probability of a global recession at around 60%. The tax cuts were supposed to pay for themselves, but federal revenue fell about 7.4% below projections in 2018 and 2019. The promised household gains did not materialize. Median wages declined and employment growth slowed. Tariffs and trade tensions triggered currency volatility, with the Chinese yuan hitting a 19-month low and other emerging market currencies weakening. China responded with retaliatory tariffs reaching 104% on some American goods, escalating a trade war that threatens global supply chains. Tariffs are taxes, and importers pass these costs on to consumers, so clothes, electronics, and other imported goods become more expensive. My verdict is that these policies present a complex set of trade-offs. The goals of stronger domestic industry, more business investment, and higher wages are sound in principle, but implementation creates real risks, including inflation, recession, global instability, and workers seeing little benefit. The data suggests a mix of supply and demand side effects that could balance out for US growth, but inflation remains a persistent risk. Markets are volatile and workers are not seeing the promised raises. The global economy is showing stress. The truth is, I believe economic policy is complicated and there are no free lunches. Every benefit comes with a cost, and it is just a question of which trade-offs we accept.